Hey everybody, Rob Maurer here, and today we're talking about some news on Tesla's Model Y in Shanghai, investment in Indonesia, the return of enhanced autopilot, and a couple of items on Tesla stock. We'll start there, where Tesla finished the week with another relatively quiet day, finishing up 0.3% to $852.23. That compared to the Nasdaq up 0.6%. Alright, so the news that seems to be capturing the most attention today is out of Shanghai. The Pacific Automotive Network in China has been granted limited access to the Model Y production factory in Shanghai. So they've taken a tour, they've shared out some photos, and most interestingly, according to Ray for Tesla, they have reported that Shanghai is currently making 29 Model Ys each hour or 700 Model Ys per day. So that 700 per day number is what people are talking about. Over 365 days, that would be 255,000 per year at that run rate, but of course there would be some downtime, so maybe somewhere around a 230,000 vehicle run rate. Now, this would of course be great news if this were true. I have my doubts. Tesla had only just reached that level of production rate for the Model 3 in Shanghai somewhere around late Q3, early Q4, so somewhere around 10 months after the start of production and somewhere around 8 months after the start of real volume production for the Model 3 in Shanghai. It looks like the Model Y really started production sometime late November or early December in Shanghai, probably actually starting to produce a reasonable volume in January. So instead of 8 to 10 months for the Model 3, you'd be looking at, really like 1 to 3 months for the Model Y. That seems like kind of a long shot to me. Let's also consider the progress that Tesla has made on the Model Y in Fremont, which over the course of 9 months in 2020, Tesla was able to ramp up production to probably somewhere around 400 vehicles per day, maybe 500 vehicles per day, best case. So are we to expect that in the course of a couple months, Shanghai was able to surpass the Fremont production rate for Model Y? I doubt it. I suspect there is some element of miscommunication involved here. Perhaps someone at Tesla mentioned to someone at the Pacific Automotive Network that 700 per day was Tesla's production capacity rather than their production rate. So I think that's likely. Another possible explanation here is that jobs per hour shouldn't be extrapolated. Perhaps that was what Tesla achieved one time. So maybe a peak hourly rate, but of course that can't be extrapolated for 24 hours a day, 7 days a week, 365 days per year. Overall, a report that I'm not getting all that excited over. Of course, we'll continue to keep a very close eye on any of the monthly numbers that we get out of China. Those should give us the best insight into the kind of production rates that Tesla is able to sustain. Next up today, we have some news on the continuing story that we've been covering on Tesla in Indonesia, which, as we know, has the highest supply of nickel in the world, highly coveted by Tesla. So today we have an update on Tesla from an Indonesian government official, and I have to read this person's title here. It's the Deputy for Investment and Mining at the Coordinating Ministry of Maritime Affairs and Investment. I mean, any title with maritime in it is already great, but this one's superlatively so. Anyway, per this person's comments and Nikkei Asia, quote, US electric vehicle maker Tesla has proposed joining Indonesia's plan to create an EV battery supply chain within the country, end quote. It sounds like Indonesia is envisioning whatever materializes from this to be a joint project between multiple companies. We've previously reported on LG Chem having interest. It sounds like CATL also has interest. Both companies, of course, Tesla already works very closely with. Indonesia's Deputy for Investment and Mining at the Coordinating Ministry of Maritime Affairs and Investment, sorry, it's Friday, I had to, said, quote, we are very excited because this Tesla lithium battery technology is among the best in the world. If we have investment from CATL, LG, plus Tesla, we can learn a lot from here because what we ask is a transfer of technology. This is an opportunity to collaborate with 3 world-class companies with advanced lithium battery technology, end quote. So it's a little tough to discern what exactly is meant there by what we ask is a transfer of technology. I think that on the face of it can be a little bit concerning. But again, these are companies that Tesla does already work closely with. And Tesla's already said many times they want these suppliers to ramp up as quickly as possible. Tesla's already working with them on 4680 cells. So I'm not sure that this would necessarily present anything different than what's already happening today. The finer details of a potential project here remain to be seen. It does sound like it would be more than just nickel mining or something like that though. The Indonesian government official said, quote, we can't allow Tesla involvement if they only want to take raw materials. This proposal is going beyond just taking raw materials, end quote. It sounds like this would be for production of full batteries and potentially a focus on energy storage. Tesla and Indonesia are scheduled to meet next week to discuss the proposal. Next today, we're talking about the return of a long-lost product for Tesla, and that is enhanced autopilot, which has made its way back into the design studio in both Europe and China. Tesla has decided to offer this at about half the price of the full self-driving option, so 3,800 euros versus 7,500 euros for full self-driving. The enhanced autopilot here includes everything in full self-driving except really the street control stuff, so not traffic light and stop sign control, and not auto steer on city streets, which of course is only in the full self-driving beta right now. Navigate on autopilot, auto lane change, auto park, and summon are the differentiating factors there from just basic standard autopilot. So a couple things on this. I think regulations in Europe have limited what Tesla's able to do compared to North America right now with the full self-driving option. That probably puts pressure on the take rate for Tesla, plus the fact that the vehicles in Europe are already more expensive, making it that much more difficult to then go and spend another 7,500 euros to add an option that doesn't even work as well as it does in North America. And then of course for China, we heard Elon on the conference call say that the FSD take rate in China was somewhere around 1% or 2%. So to drive that take rate up, Tesla can't just lower the price of the full self-driving option because Tesla already feels like that's undervalued by the customer base right now. And of course, they want the pricing for that option to be relatively consistent across markets. So introducing enhanced autopilot here allows customers to have access to that select group of features without fully handing over the keys for what Tesla feels like is an extremely valuable autonomous option for the future. Considering the fact that Tesla can't even recognize the additional revenue upfront from that full self-driving option sale anyway, if the take rate on enhanced autopilot combined with the full self-driving option exceeds what it was with just the full self-driving option before, even if that one standalone drops a bit in terms of what Tesla can recognize, that should still drive a margin increase. That's no sweat for Tesla because Tesla feels like as they start to deliver those features and as they actually work well, more people are going to opt in, or eventually Tesla's just going to be able to generate revenue and margin off of that if and when fully autonomous driving actually comes. Overall, I think a pretty good move from Tesla. All right, next here, let's take a quick look at a couple things on the stock. First up is a disclosure from BlackRock, a huge institutional investor. They have about $8.7 trillion of assets under management. They have disclosed with the SEC that they now own more than 5% of the outstanding shares of Tesla. Hitting that 5% level requires that disclosure and the SEC filing that we're seeing here. So BlackRock now owns 50.1 million shares of Tesla, valuing their position at the end of the day today at right around $42.5 billion. Overall, I don't think this should be too surprising. Last year, we'd actually talked about BlackRock. They had issued an investor update saying that they were going to be more focused on sustainability. When we had discussed it at that point in time, they had 6.4 million shares. Post-split, that would be about 32 million shares. So it's not like this is an entirely new position for BlackRock, but over the last 15 months or so, they've added about 18 million shares, which again, not too surprising given the S&P 500 inclusion over that time, and BlackRock's stated increased focus on sustainability. In other Tesla news, we had today a reiteration of an underperform rating on Tesla by Bernstein analyst Tony Sacconaghi, who has maintained his $180 price target on Tesla. Per StreetInsider.com, Bernstein offers two critiques of Tesla. Number one, quote, Tesla is stimulating demand through price cuts, and the key risk to 2021 for the stock is not whether Tesla can grow unit deliveries to about 1 million, but rather what price discounts and margins it will need to accept to deliver those units, end quote. So let's pause on that one and maybe just take, maybe 2 seconds to flip over and look at the financial results from 2020, where we can see that Tesla's automotive gross margin, excluding regulatory credits, increased 210 basis points year over year to 21% in 2020 versus 18.9% in 2019. This sort of analysis, if we can even go as far as calling it that, infuriates me because this is just a basic principle of business. You lower your prices to increase your total addressable market. If you're increasing your margins while doing that, there's absolutely no problem with that. Like, what do you think? Tesla in 2030 is going to be trying to sell 20 million $100,000 cars? No. The whole point of Tesla has been to make electric vehicles more affordable. But sorry you didn't catch that in 2006, I guess. Anyway, second point here is, quote, full self-driving is likely the key to materially higher gross margins over time, but it is unclear how much of the incremental profit stream it will choose to retain or look to try to drive further volume elasticity, end quote. I don't understand how that could be a bearish point. Tesla is going to generate higher margins through full self-driving, but they get the option to choose if they want to keep the profit or drive volume. Sounds like a pretty good option to me. Nope, $180 price target. I was going to say I hope Tony Sacconaghi listens to this and reflects on it over the weekend, but because he has that price target, I feel like there's very little chance that that's what's going to happen. But either way, we'll leave it there for today. Sorry for getting heated there at the end. It's just, oh man, it's frustrating. But that will wrap it up. As always, thanks for listening. Don't forget to subscribe, sign up for notifications. You can also find me on Twitter at Tesla Podcast. And I'll see you on Monday for the February 8th episode of Tesla Daily. Thank you.